another video by our mortgage and finance partner, John Charcol, and Ray Boulger is with me from John Charcol. And Ray, I thought for this video it'd be interesting to talk about the options that landlords have when they're coming to the end of a mortgage deal. And I think we both agree, for starters, that landlords should really be a lot more proactive in looking at the status of their portfolio and understanding where each property is at and if they have the opportunity to improve the deal.
Absolutely they should. If one does nothing when you come to the end of a deal, chances are you're going to revert to the lender's standard variable rate or perhaps a bank rate tracker. And in nearly every case that's going to be significantly higher than the rate one was paying, and B, the rate that one could get if one did something. So doing nothing is an absolutely bad idea. Having said that, one does need to consider whether the intention is to retain the property for a reasonable period. If, for example, the expectation is that one's going to sell the property within a few months, it might be worthwhile just paying the relatively high rate for a short while to retain the flexibility. But for most people, assuming they're going to keep the property, the two fundamental options are a remortgage or a product transfer. Now, people often get confused by product transfers and tend to think of a product transfer in the same way as a remortgage. Now, they are alternatives, but they're very different. Fundamentally, a remortgage is where you keep the property but change lenders. A product transfer is where you keep the property and stay with the same lender but go on to a different deal. And one of the key benefits of a product transfer is that, providing you're not planning to borrow more money or change the term of the mortgage, most lenders will offer you another deal without further underwriting the situation. So take the example of somebody who took out a mortgage 2 or 3 years ago before the current stricter rules on affordability came in. Could well be that now you wouldn't qualify for a remortgage because the rental cover required doesn't stack up with what's required in today's market. However, you could get a product transfer. And so, although in an ideal world, it's good to compare product transfers and remortgages, because then you can look at what the best deal is. If you don't qualify for a remortgage, that doesn't mean to say you can't get another deal. So always worth having a conversation with us, and we can then point you in the right direction and advise you whether you have both options or whether you only need to look at a product transfer. And product transfers are simpler because there's no underwriting required. They're quicker. You don't normally have to produce much paperwork, but you still need to make some decisions, because there will normally be a choice between a 2-year fixed rate, a 5-year fixed rate, maybe a 3-year fixed rate, perhaps a discount or tracker product. So you've still got to make the same decision as if you are remortgaging, and for that most people will want some advice, and that's where we can come in.
Definitely. Product transfers could typically be just a like-for-like amount. If you were looking to release equity, then clearly that would be a remortgage situation. And there's some very favourable rates around at the moment, isn't there?
There are. If you are looking to release equity, it doesn't have to be a remortgage, because that will, in most cases, probably be what works best. But the alternative might be to do a further advance with your lender and then do a product transfer on the new deal. Now, it's important, if you're going to do that, it's done in the right way. And if you are going to do that, you will have to go through the same affordability checks as if you were remortgaging. But the rates available at the moment are really, really good. So, although bank rate has gone up a quarter, and it's probably going to go up more later this year, rates are still very close to all-time lows. And particularly buy-to-let rates, where the margin compression between residential and buy-to-let rates continues to happen. So buy-to-let rates are still very close to all-time lows. So now is a really good time to lock in my view, to a reasonably long-term deal, so 5 years, so that when rates do go up, and it's a question of when, not if, then at least you're insulated against that.
Absolutely. Well, that really is the $64 million question on PropertyTribes. People are, constantly asking, should I fix? If I'm going to fix, how long for? And again, we can't say it enough. This is where the benefit of speaking to a broker comes in, because the broker knows the whole of market. The broker can get a very good feel of the client's position and give some good advice.
Exactly. And whilst it's not always right to take a fixed rate, at this point in time, I think that's definitely the route to go. And indeed, the vast majority of new mortgages today are taken out on a fixed rate. The time when you might not want a fixed rate is when one feels interest rates are near the top and might come down. But if you compare the rates currently available on a fixed rate or a discounted rate, actually there's very little difference. So the only reason to justify taking something other than a fixed rate is if you can start off with the rate sufficiently lower to insulate you against the rate rises, and that doesn't really apply. So that's why I think fixed rates are really good value at the moment. There are a few deals available with no early repayment charges, but most deals do have early repayment charges, so one does have to consider how long you're going to keep the property. Quite a lot of deals are portable, but not all, so again, that's something we can clearly advise clients on. One other type of mortgage, which only a few lenders offer, but will suit some landlords, is an offset mortgage. And if, for example, you are accumulating quite a bit of rent and you want to set that aside to pay your tax bill or perhaps to build up equity for another property, could well make sense to have an offset mortgage so that you're effectively only paying tax on the net amount you borrowed, because the way an offset mortgage works is that you have a separate savings account linked to your mortgage and you're only charged interest on the net amount. But the savings account is your money. You can access it when you want it without going through any approval, and therefore you know when you need a deposit to buy a new property, you can get hold of the money. You haven't got to go through, for example, a bridging lender or something else if you need a deal quickly.
And there are buy-to-let offset mortgages?
Very few, but there are 2 or 3 lenders that offer those. Now, clearly, if you have to pay a premium to get one, it might not be worthwhile. But again, it's something that might well be worth considering.
Definitely. At what point, coming towards the end of a fixed deal, should they start thinking about remortgaging?
I would say a good time is about 6 months before the deal ends. Now, most lenders' mortgage offers are valid for between 3 and 6 months. If one's going to do a product transfer, typically you can lock into a new deal about 3 months before the deal ends. So come and talk to us 6 months before the deal ends. That means that we can start going through the fact-find process, look at the options, and if it makes sense to make an application quickly, perhaps because rates are going up, then we can get an application in, make sure we use a lender that's going to give you an offer that's still going to be valid, obviously, when your current deal expires. It might well be that we say, come back and talk to us again in 2 months' time and we'll then finalise the deal. But if we've got all the info, we can do that quickly. And if rates start to move, it puts us in a much stronger position than if we've got to start from scratch.
Very, very good point. And I guess just to finish, landlords are going to have to expect to provide more information for the underwriting process. I've heard a few landlords complaining about the amount of information they had to provide. Now, this is not brokers being difficult or anything like that. This is the PRA in effect.
It absolutely is. The last thing a broker is going to want to do is be difficult. Apart from anything else, if the lender wants more information, it's more work for the broker as well as for the client. So one of the key things that we can help clients with is in understanding what different lenders' requirements are. And particularly for those clients whose LTV is relatively low, there may well be some clients that want significantly less information, some lenders who want significantly less information than others. So for a client who's got all their information readily to hand, got all their portfolio on a spreadsheet and can provide the information quickly, none of that may be a problem. But for some of those landlords who are perhaps a bit less well organised, it may well be that part of the decision as to which lender to use is which one is going to be a little bit easier to deal with in terms of the information they require.
Absolutely. Well, once again, Ray, thank you very much for joining me here, and I've certainly learned something new in this interview today, and I do hope you have as well.